everybody to the rewrite. I have such an interesting, unique topic for you today. If you love learning about wealth, if you love learning about just building money, your assets, creative ways you can do it that's not really talked about, I have the guest for you. Today we have DeAndre Clayton, and he is from Clayton Financial Solutions. I was searching for this unique concept. I'm not even going to reveal the name of it yet. And I found him. And out of all of the people that I watched, he explained it so clearly. I found him on another YouTube channel by a great presenter, a guy who's in real estate investing, Jamel Gibbs. So shout out to Jamel Gibbs. But DeAndre, thank you for coming on. You are a busy, in demand man. Thank you so much.
Thank you so much, Joe. Should we be calling you Joe or Jolise? Which way we going today?
Usually people call me that, so that means we're good now.
I felt Joe was just kind of slipped off, so I said, all right, we're just gonna go with Joe.
Yeah, we're good. So, DeAndre, tell me about your business, Clayton Financial Solutions, and the services you and your wife offer. This is a joint venture.
Yes, yes, yes. So sometimes when people ask me like, "What do we do?" I'm like, "What don't we do?" I think it's like that feeling after you've kind of done this one thing, mastered it, you go into another thing, mastered, and then it's like, oh my goodness, I do a lot of different things. So Clayton Financial Solutions is really like a boutique of services and strategies really to appeal to anybody at any level of income. We've done everything from helping people to fill out Medicaid applications, helping people to get their VA benefits, to setting up complex estates for real estate investors. So it's very well rounded because of the extent of where I've been and different things I've done. So the basis of, if we were talking product or anything like that, Medicare, retirement planning, we do Roth conversions, pension optimization, cash flow analysis, which is kind of a little bit leading to the topic a little bit. Um, Health insurance alternatives such as HMAs and different things like that for pets and humans. Um, I mean, my goodness, disability insurance, long term care, whatever you can think of on the financial spectrum. And then kind of the things that make us very different than the regular financial firm is that we also recover for money too for a client. So we've helped clients on a personal basis to be able to recover like foreclosure funds.
Wow.
So, like if they've had their home foreclosed on, we've actually gone after the funds, hired the lawyer, taken care of that, and then been able to retrieve the money from the auction. That was the overpayment or the surplus that was there. Um, and then that trickles into the other recovery business that we have, which focuses on employee retention credit, where we've helped companies. I think at this point we've recovered about 25 million for companies. So yeah, it's been a wild ride over the past few years. Yeah. Yeah.
When we talk before, that's a big
Yeah.
number. That's
Yeah, it is. It
yeah.
is. It is.
And so
Yeah,
you
it's
relationships, you really built. Is it word of mouth for you now? You don't really have to hit the pavement, the phone so much. It's more word of mouth.
oh man, it's funny because I have never really been a lead purchase person.
Yeah.
So I typically started off like when I started with retirement planning, it was with teachers. So I would go into a school and then I would serve them lunch or whatever the case may be, and then I'll go ahead and help them with their pensions and helping them kind of look over their benefits and understand what's going to happen at that point. So that wasn't like a lead base thing. And then after that, when I went into Medicare, I partnered with a company. One company I partnered with, Oak Street Health, which I really, really love. They focus on at need areas. But basically, I bought a lot of resources to them, and they bought resources to me and built up my Medicare business. So, kind of pounding the pavement, PTAs, whatever you could think of, senior facilities, homeless shelters, different types of places, in reference to that business. So yeah, it's always been sort of word of mouth or me actually just being in the community.
Yep, yep. Well, thank you for saying that. So now we know,
Yeah.
it's a mix. But I know, just with you and the way that you present, I can't wait to hear what we talk about, what this is really about. I can see that it's just more relationship with you too. It's easy to
Oh yeah. Yeah. Yeah.
educate.
Yeah.
Okay, so the services you guys offer are so rich, but today we'll be focusing on becoming your own bank through infinite banking. What is
Yeah.
infinite banking?
Man, what a loaded question, right?
Yep, yep.
Um, so infinite banking is something that personally I practice, but I've helped so many clients with and I know this will be something we talk about a little bit later, but really kind of understanding that it is a finance replacement strategy. Like so we're using whole life policies um that were designed from a mutually owned life insurance company
Hmm.
and basically kind of using the customizations that's within it to be able to create a tool that grows money very quickly, and that allows you to take a different look at life insurance. So you're not taking a look at, oh, it's just for death benefit. It's more of a focus of how do I build cash flow? How do I feel this choice now? And I think that's kind of what's beautiful about it is if you've thought about life insurance, I always tell people life insurance is a very selfless thing to do. But the average person, because of how hard life is, it's hard for them to be selfless,
Mm,
right? So their mind is like, why would I ever invest a lot of money into this particular tool or strategy? But this infinite banking concept, it now allows you to kind of take the control back of what this tool actually was meant to do and be able to say, okay, well, for a large portion of the money that I'm putting in here, I could say that every dollar that goes towards the cash value will continue working for me for the rest of my life, right? And that's the basis of what infinite banking really is about.
great explanation.
Yeah.
So this is kind of a magic question. How many years has infinite banking or just this method of building wealth? How long has it been active?
Oh gosh. Well, so it didn't have the name infinite banking initially. So the person who coined that is Nelson Nash. So a lot of people know Become Your Own Banker, that book. I got it somewhere very close nearby because I have to always look at it for different reasons. But that book was published in the year 2000. However, when you look at the layout of the company that has the oldest dividend payout, their oldest dividend payout is 1869, right? So
Wow.
1869. In fact, there's a book called "What Would the Rockefellers Do," and I think Garrett Gunderson had published it, but
Yeah, yeah.
but he actually interviewed the Rockefellers. Like he interviewed the family and they talked about their use of using the insurance policies that way. And if you kind of date back, that's in the 1800s. So it shows that this has really stood the test of time, even longer than our country. just about really just about if you really think about it. So it's really exciting to see how far it's gone.
So why is infinite banking not as well known or talked about
Mm,
in the insurance community? It's easy to sit with a life insurance agent, right? I'm a
right,
licensed one, so I've done it for a
right,
little bit, and talk about
right.
term insurance, talk about index universal life, but not this concept. This is just not one that
Right, right. So, oh my goodness. So there's a number of reasons, and they are not popular. So I'll go ahead.
conspiracy theories about to come out, y'all. Good ones
No, no.
though.
Well, it's not conspiracy theory. It's actually if you just break down data. So, and I will say this that infinite banking. One of the reasons why it's not popular
Mhm.
is because it's active. It's not passive. And what I mean by that is infinite banking requires you to take more control of your finances,
Mm,
right? Sometimes you may think, oh, well, I do have control of my finances. But a lot of times, the outcomes that most people invest in, for instance, there are outcomes that they have no control over. They don't even think about the outcomes. They just, oh, well, I hope the money manager handles it and it'll be great at the end of the day, right? And so I think that infinite banking is the path of most resistance.
Hmm.
Most resistance from two different areas. You have it from the financial advisors and the financial planners because, when you hear phraseology like buy term and invest the difference, what you get from buy term and invest the difference is like, okay, well, if you get term insurance, it's really cheap, but then put the rest of the money into investments, right? And so you'd have to think sometimes when people say, "Oh, well, I'm going to run this by my financial planner," and they kind of think, "Oh, well, are you going to be scared if I run it past my financial planner?" And I tell them, "Well, I don't really care if you run it by your financial planner or not. I want you to understand that the answers that your financial planner is going to give you is going to be based off of speculation, right? So if they say that this is good or bad,
Yeah.
they're they're judging something that has a more guaranteed nature against something that doesn't have a guarantee, and they're telling you that the thing that is guaranteed, it's a bad idea, but the thing that isn't guaranteed, it's a great idea. And then when you kind of take that look back and you step back and think about that, it's like, hold on, why would that, because you have old adages like a bird in the hand is better than two in the bush, those kind of things, right? And it's like, okay, well, how could I believe a bird in the hand is better than two in the bush, but also believe that high risk, high reward makes sense? And the reality is you don't believe it. Um, you definitely don't believe it because you might have family in your life who may ask to borrow money and they're not that responsible. You wouldn't lend it to them because you don't believe that high risk, high reward makes sense.
Gift at that point.
You don't think that, right? But because of the education of the individual who's coming to you and saying, "Hey, we'll take care of you in a stock market or something like that," your mind says, "Oh yeah, high risk. It makes sense this time. It's a good thing." So I would say commissions is one of the problems. Because you want to talk about why it's not popular. There's two sides of the spectrum on the financial industry. You have the insurance side and you have the investment side.
Hmm.
So the insurance side, when it's not popularized on the insurance side, it's because of commissions. You make significantly less money setting up these accounts. Significantly less money setting up these accounts. So, for instance, oftentimes I'm taking a 90% hit on setting up a properly designed infinite banking policy. So, for instance, I might design a policy for $20,000 a year for a client. Now,
Yeah.
most people would think $20,000 a year going into a life insurance. Oh, he's just getting huge commissions. But because I service clients who are in the Medicare industry as well, I could do a policy for $200 a month and get paid more off of that than I would a $20,000 a year policy that's structured for infinite banking because so much of it is going towards cash value and not the cost of insurance that now my income is greatly affected. So, if I would say why IBC is not really spoken about well in the insurance industry, that would be the insurance standpoint for the person who is on the investment side. um, the reason why it wouldn't be spoken of well, once again, and I say boils all the way down to commissions, what you get paid. So an investment person goes off of AUM, which is their management fee, right? But they will say, oh, if you set up an IB, oh, those guys setting up those policies, they're only doing it for high commission. AUM is more commission than an infinite banking policy by far.
Hmm.
So just to kind of help people to understand this, like an insurance agent gets paid on the first year. That's when the bulk of their money comes in. But the insurance agent never gets paid from your money. They get paid from the insurance company, right? So when you talk about, okay, well, why would somebody suggest this? That doesn't benefit or that doesn't hurt the client when an insurance agent gets paid. A lot of people don't think about that. However, when a investment advisor is paid, it comes as a fee of
Mhm.
what the account value is.
Mhm.
So the fee comes directly out of the account. So if I'm the investment guy, I'm going to tell you buy term and invest the difference, because
Yeah.
why would I want you to have $500,000 sitting in an insurance policy when I could be receiving, 1 to 2% every year off of it? And so that money grows, early on, of course, the insurance agent may be paid more early on an account. But
Mhm.
as 30 years goes by and the account value is significantly higher, an investment advisor is paid significantly more. In fact, there's a documentary called The Retirement Gamble, and I advise every one of anybody listening to you to look at this documentary, because what it helps people to understand is there is about 2/3 of your account value that's taken away in fees in a 401k or mutual funds and different places like that. Um, and
Mhm.
so so it's very surprising, because you hear these things about compound interest and all these different things and you get really excited, but most don't tell you that there's a fee structure to that, and you're not able to even see the fee structure. Oftentimes I've rolled over tons of money, and a lot of times when I roll over money, there's no fee structure that's disclosed on their TSPs, on their 401ks or whatnot, which is kind of rich for an investment person to say that this product has a lot of fees, because this product actually discloses the fees.
Mhm.
So there's a different conversation that we had there about what's disclosed and what isn't. But the other part is people want what they can't have.
Mhm.
That's another reason, right? So the dream of making a significant amount of money without doing any work
Mhm.
is very tantalizing to the average person.
Wow.
So
Wow.
it's nice to sit my money here and just say, oh, it's going to be $6 billion one day based on the market, right? Whereas in the infinite banking world, the focus is not even the growth on the policy. That will happen. The focus is on what you're doing with the money that you're borrowing from the policy, because that will give you a higher profit margin than any market or the insurance policy could do, for that sake. So I'm always very forthcoming with the client and letting them know, that the best thing about them is them.
Yeah.
It's it's you, right?
Yeah.
And so putting money into yourself and doing different things, it really, really does help to bolster what your net worth is. And it's an active net worth. It's not something that changes because you lost 30%. And then it's like, oh man, my net worth just dropped by 30%, like 32%, like last year for many who had their money in the market.
Yeah.
Um, so I would say that those are the reasons why it's really not popular. It's being spoken about a lot more now, which I'm really happy about.
Social media.
Um,
Just
but
to.
yeah. Hmm.
Okay. And so, what are the advantages of setting up an infinite banking policy?
Oh man. So I would say from the offset, like when I first started setting up these policies, the main advantage that I had, and I didn't even know I was doing infinite banking at first. So I'll just, I gotta let that be known. I was doing debt consolidation with insurance policies. And so that was probably one of the biggest aspects of it is
Debt.
the it allows you to basically have a mastery of debt or interest, right? Where you can decide, for instance, if I was a person who wanted to take out a credit card and the credit card is 25% interest, I could decide that I never want to pay compound interest. Now, I could decide it two different ways. I could either use an infinite banking style policy and take the loan out and pay it, right? Pay what's been built up on it. Or I can pay it from my own funds. the problem that would happen when I'm paying it from my own funds is I feel like I just lost that money. I never have any gain from that money. It hurt, right? So I would say the advantage of it is it helps you to look at money differently.
Mhm.
um you look at money like, okay, well, I want it to be my employee. I don't want to be an employee for it, right?
That's true.
um
Yeah.
and that's the part about infinite banking that I think is really, really advantageous, is you start to become more of a steward of money than you ever were before. um because you're like, okay, all right, so if I'm gonna lend money out, for whatever this is, what's my comps, right? You start to be really involved in it. Whereas, there's been times where you've used money and you said, okay, well, I'm just gonna allow this money to come out of my check. And there's no active feeling about that.
Mhm.
And it's an ignorant bliss
Mhm.
or what have you. And so I would say there's this aspect of being able to say, okay, I don't want my ignorance to cause bliss. I want my reality to cause bliss.
Yeah.
I want to be able to know that, okay, what I just did, it's going to make me this much money, or it's going to save me this much money,
Wow.
right? And
Yeah.
that's the benefit of infinite banking. I would say the main advantage. The other advantage is the what ifs. Like, if bad things happen in your life, what does the policy do for you? Um and I'm, of course, I'm known for infinite banking. I'm also known for velocity banking. But one thing that I say about an insurance policy or a HELOC, a first position HELOC, is it is a symbiotic strategy, right? And so if you think about biology, for instance, biology, you have different mutual forms of relationships. And one of the forms of relationships is a parasitic relationship, right? And so the parasitic relationship might be the one you have with your regular bank.
Hmm.
You may not think about it, but kind of start to realize what you're doing, because that's really what shows the value of infinite banking. So, for instance, when you put money into a bank, you are loaning them money. Have you ever thought about it as a loan? Right? And if you did think about it as a loan, what rate would you like to set for them to pay you back? Right? Most people don't think in those terms,
Yeah.
but it actually is a loan, which is the reason why they have to pay you some interest.
Hmm.
They just decide their own parameters for it, right? And so that advantage of saying, "Hey, no, I can take control of the banking function, and I can set the parameters for how much of this I want to grow at what pace I want it to grow at."
Mhm.
Um, and then on the back end of that, if something were to happen to me, if I were to get sick, if I were to die or anything like that, there's an even bigger benefit waiting in the range for my family. I think when you talk about infinite banking, it is the generational wealth
Yeah.
concept,
Yeah.
right? Um, Whereas the buy term and invest the difference, it is not a generational wealth concept.
Mm.
And the reason why it's not a generational wealth concept is because it's focused on only one person. You're not leaving anything behind, right? Oh, insurance, it costs too much. So you didn't really risk too much. In fact, all you did was risk your principal, because there's a 99% chance it's not gonna pay out. It's a 99.
That's why it's so cheap. Yeah.
Yeah, it's so cheap because it doesn't pay out. And so when you hear the comparisons, and I want people to actually think, right? When you hear the comparisons of whole life and term, and then somebody says, "Well, term is so cheap," and I'm like, "But if it doesn't pay out 99% of the time, why do you care that it's cheap? It's very expensive.
Mhm. Mhm.
Anything is expensive that there is nothing in return for, right?" And so the infinite banking policy, at the very least, it says there will be something at the end of this road for you,
Yeah.
right? So that's number one. But number two, it allows you to be active. It allows you to actually see the results immediately. and not guess that something's going to happen in 30 years.
I
Right.
like that. Yeah.
So
Yeah.
that's the advantage. And that comes with a good night's rest. Right. That
Control. You talked a lot about that. Being in
comes with a
control.
good night's rest. Comes
Yeah.
with a good night's rest because you know what's happening.
Words. Yeah.
Um, yeah, long-term care, disability, debt payoff. You could go on about the benefits of infinite banking. And I think that's the reason why it's called infinite, right? Because
Infinite
the
possible.
longer and longer you do it, the more you're like,
Use
I
it.
didn't even think about that. I didn't, oh my God, I didn't, and you start realizing, because if you think about how much banking is a function in your life, oh my gosh, like
Mhm.
it's everywhere. Banking is like the seed of everything in your life. So when you start to replace it, when I say replace it, I don't want people to think I'm radical, right?
Okay.
So I'm not saying that you have to put all of your money inside of an insurance policy. One, you can't put all of your money inside of one insurance policy because that's not even compliant and they won't allow it, right?
Mhm.
What I would say is, what are the things you want to accomplish? Is it you want to buy real estate? Is it you want to start a business? What would be a better place to get that type of funding from here on out, right? Because your daily expenses, your grocery store, your all that kind of stuff, you can continue doing that with the bank. Yeah, that's okay.
Yeah.
You can continue. That's not a big deal.
Yeah.
But what is a big deal is the things that you're going out and you're taking huge loans out for, or the things that you're being neglected as a person who's in the bank or using that bank, and you're being turned away from, right?
And that happens because life
So
happens.
that
Yeah.
that happens, right? And so there is no credit score on an insurance policy. When you select to borrow your money, is one button, and then you select how much you want, and then the next thing you see is that the loan has been processed. There's no loan officer,
Yeah.
right? So you're not going to get debt to income ratio conversations. You're not going to get net worth conversations when you're taking loans out. And that's funny because the bank is using your money all the time.
Hmm.
So they're growing your money all the time anyways, but they still put you through some rigorous things in order for
Look at
you to access their money, right?
wow.
Um, and that's something that a lot of people don't think about. Like, oh man, I've been banking with these people for forever,
Hmm.
but and they're writing mortgage notes off of the money that I'm putting in here, right?
Wow.
Because for every dollar you put in, they loan out 10. That's fractional banking.
Mhm.
And so you have to say, okay, well, especially if you're looking at the landscape now, aren't there banks always closing down now?
We just looked this morning in church service. They were talking about the tech industry and how those
Yeah,
things out of nowhere when cryptocurrency kind of went down. Those things just out of nowhere. Yeah.
I don't. Yeah, yeah. Back in 2008, there were banks that were, oh my gosh, the amount of banks that were bailed out in 2008 is startling. But then the other part of it is, a lot of people don't know that there's also bank owned life insurance.
Hmm.
There's company owned life insurance. And so, um, whenever I hear somebody talk crazy about life insurance, I'm like, okay, do you guys realize that banks own, like last year they bought over like $112 billion of life insurance last year, not the year before that, just last year, right? And why do they do it? To fund employee benefits, to do a number of different things. So banks aren't taking chances. They are making sure that they have, a tier one asset
Hmm.
that's in place that is safe, right? They're not just stock, and let's see what happens. And now let's try to fund our employee benefits, right? And so carry yourself like a business is really what the infinite banking concept is about.
Write that down. Carry your
Yeah.
what?
Yeah,
Yes.
absolutely.
Yes. All right. And so, can this policy be designed to replace existing policies that a person might have?
So, so the two things. So, if a person had a convertible term, they could convert into one of these policies without having to be re-underwritten,
Hmm.
right? So whatever health condition they were at their previous age when they first got the convertible term, they can convert right over and have no problems with that. In reference to like if you can use the existing contract that you have to start using this function, it would only be possible if the existing contract is from a mutually owned life insurance company,
Okay.
right? So, and then of course, what were the parameters when that contract was written, right? So, you're not really going to do too much changing
Hmm.
after the contract is written. That's going to allow you the wiggle room of saying, "Hey, well, I've been putting 100% of my premium here. Now, can I put 90% of my premium here?" you know, that's not going to happen traditionally. So, usually, you would want to speak with someone who has a good understanding of how infinite banking works and how to design these policies efficiently.
And there are only a few life insurance companies that will allow you to do this. It's not a lot of them, right?
Yeah, not a lot of them. Not a lot of them. As I mentioned, it's definitely going to start with the mutually owned life
Yeah.
insurance companies, and I'm glad you asked that question too, because I mean some of the naysayers when we talked about commission and how much money infinite banking makes the insurance company, why wouldn't every insurance company do it?
Mhm. There's just no money, right, in it
If
for them.
if it was making them so much money, they would all do it, right?
Yeah,
Um,
they don't want to be
but
bound
they
by.
don't.
Yeah.
Right, and so and that's really interesting because I want people to understand this. Infinite banking is a privilege. The concept is a privilege for you to use. It's not something that is granted to everyone, right? So rather it be, if you see me on the podcast, you hear me talk about infinite banking, you hear me talk about velocity banking and first lien HELOC. Anytime something takes a long time to be underwritten, that means that it's for the client.
Mm.
Anytime it takes a very quick time period to be underwritten, that means it's for the company,
Hmm.
right? So, why do I say that? Well, you think about if you went to go get a mortgage, for instance, getting a mortgage is a lot easier than getting a first position.
Yeah.
It's way easier. If you think about even setting up an investment account,
Yeah.
you go to work and you could be automated into investing without you ever meeting with an advisor.
Yeah.
So like really think about that. Somebody could just go ahead and say, we're going to take a percentage of your income without speaking to you and start this account on your behalf. How could it be the best thing for you if that were the case? And we're not talking about a pension because it's not a defined, it would be different if it was a defined benefit and not a defined contribution. Because a defined benefit, it's like, okay, well, I get that. Social Security is a defined benefit. I get that. A pension is a defined benefit. I get that. I work at the railroad or have VA or those are defined benefits. But a 401k and many of the retirement plans that you're used to using are not defined benefits, they're defined contribution. So imagine what it would feel like to define that we're taking this much from you, but we're not defining what it's going to do for you, right? That's what you go through every single day. And you do it because you think, well, of course, they got my best interest at heart,
Something. Yeah.
right?
That's not really being actively participating in your
It's
financial.
not actively participating. It's not actively participating. And that's what I want people to get out of, anytime that I speak, it's you want to be intentional when you invest money, right? So investing because there's a risk, you should be intentional, right? You
Mhm.
wouldn't you wouldn't go into a casino and just kind of show up and say, "Hey, I'm playing whatever game. Hey, don't tell me the rules. I'm at a poker table or I'm at a blackjack table. Don't tell me the rules. I'm okay. I'm just gonna play." You wouldn't do that, but you normally do that.
Yeah, we do.
You normally do that. you
Then
know
wake up 10 years later and you're like, what?
what just happened? You're like, how did that happen? What?
And then
What?
that's my story, right? You wake up and you're like, oh,
Yeah,
I need to learn everything I need to learn because
yeah.
time is of the essence now. Yeah.
Well, Joe. The good thing is you're early on. Most people, because you're waiting for 30 years, most of them are finding about, hey, was this right or wrong after 30 years when they can't do anything about it. So they're in their 60s. Maybe they're getting deferred taxes, and they're starting to realize, hey, this income, it's oh, this money from this, it's bumping up my income. Oh, it's creating other problems because I didn't know there was going to be problems from drawing from these accounts. I didn't know that they would make matters worse, possibly.
Yeah.
I didn't know that my health care would cost a minimum of maybe $500 or $600 more a month just because where I'm drawing from, right?
Mhm.
And what I'm talking about is IRMA for anybody who doesn't know. Because I'm a Medicare professional and an infinite banking guy, I kind of have a more macro level view of why infinite banking is really important or why Roth conversions are important. It's because of taxes on the back end and what the effects of taxes do on the back end for a senior. It destroys their accounts. It destroys their accounts. It just eats it all the way up, and then their expenses are even more because, hey, your income on paper looks so good that I'm not going to cut you a break on drug costs. I'm not going to cut you a break on healthcare because your income looks great,
Wow.
right? And so that's a part of what IRMA is doing. IRMA's, right now, clients, a regular client who didn't have much income is about 174 per year. I mean, per month in a Part B premium for Medicare. If you add income onto that for a lot of them, those who have higher incomes, that Medicare Part B premium becomes 574. And that doesn't even pay for the drug cost. That's just the Medicare premium going up. And then they haven't talked about a Medicare supplement. They haven't talked about a Medicare Advantage. We haven't talked about if they need long term care. 70% of people need long term care. Like,
It's a lot.
it it gets crazy, and so simply just investing and hoping that something happens
Yeah.
when there's definitive numbers about how serious things will get the further you get in life, it's just not a wise decision.
Yeah. Yeah. Awesome. I mean, I'm speechless, but now
No.
examples. Let's take a look at some of the infinite banking policies.
Oh, okay, sure. Let me see here. Let's see what we got here.
Mhm.
All right. So this is what I like to call the and I'm not a fan of using the word retirement. I've said it a few times just because people relate to it. I don't believe that, retirement is the right word. I think passive income time is a better way to describe it than retirement, because if a person wants to continue doing things, they should have the right to continue doing things, right? So that's
Word.
first and foremost.
Yes.
So one thing about how these things are ran is you always want to go with a company that pays a dividend, because when you're with a mutually owned company, the dividend is awarded to you because you're part owner of that company, right? So they have to share in profits with you. So right here, what you see here is it says the potential to receive dividends, right? So it says while dividends are not guaranteed, so we have to use the compliance wordage, right? It says Mass Mutual has paid them to eligible participating policy owners every year since 1869. So, not guaranteed, but has been paid every year since 1869. Now, you do with that what you want. I will not tell you that it is guaranteed because that's not compliant, but I want you to think about all the situations that have occurred throughout life since 1869?
Right. Right.
How many recessions, depressions have occurred and a dividend has still been issued, right?
Yeah.
Now, this is a design that I want people to see because I don't think they really wrap their head around how powerful an insurance policy could be. Um, but with a more normal or closer to normal situation. Um, so this is a client, let's say they were putting in $20,000 of premium for 10 years, right? But I'm going to do some tricky things at the bottom of this that's going to be really cool to look at. But this is if they were 30 years old. Now, I want you to note that it says the loan interest rate is 5.29% adjustable. So, one thing about insurance policies, their interest rate, while yes, we do mean it is adjustable, so it can be higher next year, so on and so forth. That is true. However, it is a simple annual interest loan. So, why do I say that? Because whatever you borrowed, it has a 12-month period before interest is actually charged on it, right? And I hope that when you hear that, you start to realize, oh, this is really good for consolidating debt. This is really good for consolidating debt, right? Some of you listening may have gotten debt consolidation loans and different things like that, maybe a credit card that was 0% for an extended period of time to start offloading debt. This technically is that, right? Now, the cool part about it is with it being like an annual interest loan, let's say if you paid off whatever debt in half the year, they would actually rebate you the half a year's interest on the loan,
Mm-hmm. Mm-hmm.
right? So if the half a year interest was 5,000 and 6 months in you said, "Hey, I got the money, I'm going to pay the whole loan off," they would then give you $2,500 back. They would send you a check for $2,500.
Wow.
That's really cool,
Yeah.
right?
Yeah.
But that's not just the only reason why it's really good. So we're going to go ahead and kind of just take a look at these numbers because I think it's going to be startling when people see what an insurance policy can do, right? So as I mentioned, first 10 years, you have 20,000. That is the premium on this account. Now you'll notice it's stating that by the end of the year, the cash value would be $17,713. Does that sound like a really, really expensive insurance policy anymore?
Money's available at the end of the year, right? If you need it.
Right. So I'm going to give you an example of what
Yeah.
would be available immediately depending on how the premium is paid. So you got a few different ways you can pay premium. You can pay premium monthly, you can pay premium yearly, you can pay it quarterly, so on and so forth. Whatever you are paying in, the availability of the funds usually is going to be about 87 to 90% of whatever you've paid in,
Mm-hmm.
right? So if you did an annual premium and you dropped the 20,000 in there right away, then what's going to open up maybe about 87 to 90% of that immediately, not waiting for 3 years, not waiting for 7 years, not waiting for 10 years, not waiting for the full year. I want that to be clear because that is a very big separating fact behind using a whole life policy versus using an IUL. So I'm going to say something that might hurt somebody's feelings. Normally, when you see TikTok videos and they're saying negative or you hear about infinite banking, a lot of them are talking about IULs, right? And IULs are different products altogether. Yes, they are insurance policies, but the way they are structured, they normally have a rising cost in reference to the cost of insurance going up. So it doesn't have the same attained age underwriting to it. It kind of has a current issue. So in essence, the IUL says, hey, it's an index universal life. Therefore, universal means that your funding is universal, which also means your costs can be flexible too, right? And so When you look at an insurance policy that is a whole life design policy, you can fix the parameters of what the cost is. You can decide how much the cost is for the life of the contract. It's not something that's like, oh, well, I might have to go up now because of the rising cost of insurance. No, the cost of insurance is not rising. So I want to make sure that's clear, because a lot of times when infinite banking gets a bad rap, like when I hear CFPs try to get on their high horse talking about it, or whoever trying to talk about it, they mix up the language and they use what an IUL does to discredit a whole life policy. And that's not right. Let's represent it for what it is. Just the same way as if I was talking about investments, I would not mention that Amazon stock is the same as, whatever new company stock that there is. Like, there is a difference, right? And so it's important to recognize that insurance policies, they are not linear. They're not the same. Not every policy is made the same, just like every stock isn't made the same. There will be no such thing as blue chip if it wasn't different, right? So I just want to make sure that's clear before I go a little bit further into it. But when you look at this contract, what you're seeing here, you're seeing a 10-year layout, and now this is funny right here. Then you see 17,500. Now, the way I designed this policy, which a lot of people wouldn't even think is possible, was to design it as a 10-year whole pay, meaning that the policy is fully paid up after 10 years, which means you no longer have the cost of insurance on the contract. However, I optimized it by allowing you to continue paying towards the cash value for another, 12 years in this design. That's a lot more customized than what people would say to you about infinite banking or an insurance policy. So in these years, there is no cost of insurance. That's just straight towards cash value, right? And when you see the growth on it and you see what happens as far as the death benefit is concerned, I always like to focus on a few different dates. So I like to focus on right after there's no more contributing. So right here, a client could be at age 53 if they started this at 30, followed the program, and you're looking at $35,111 as the passive that came in that year from this policy, net, not gross, net, right?
What you're saying is the policy just is still making money without you having to put money into it.
Yep. The dividend is still crediting on top of itself, right? And so, really, if I would say, if there's a place where you could have compound interest, I think the only true place where you have like uninterrupted compound interest is actually in an insurance policy, right? Now, here's the problem. Most people associate uninterrupted compound interest with just large values and not necessarily the process of how money grows in an account. But when we talk about uninterrupted, that means when the market went down, it still did what it does. It didn't care, right? It doesn't care about the world events. It doesn't care that so and so got bombed. It doesn't care, right? It's still chugging along. That's uninterrupted. That's what I think of when I think about uninterrupted compound interest. So if you talk about the power of 72, that is not something that is present in an investment. You can't invest and get the power of 72, which has always been associated with the power of 72. But why can I say you can't invest and get the power of 72? Because growth isn't guaranteed. Growth has to be guaranteed. There has to be some baseline on the account in order to create that, right? And then once that baseline has been created, the cost of that account also has to have a baseline as well in order to create compound interest, right? Not a situation where the fees grow more the value of it is. That's not how an insurance policy works. That's how an investment portfolio works, right? And so I use that because there's three different segments. This is talking about saving. This isn't even investing.
Right.
This is not investing because legally investing is when you have the opportunity to lose money. Now I don't call that an opportunity, but when when you when you can lose money in an account, that is what is classified as an investment. You can't lose money here. Every dollar is it's called for, right? So every dollar is either going two different ways. It's either going towards the cost of insurance or it's going towards the cash value, right? Now, at the bottom of this contract, you're watching every dollar then start going just towards cash value and no cost of insurance included.
Now, where's the cash value at? Is that on the far right side? The
The
million?
cash value, all right, so let's go up here so you can just kind of see it. So this is the net cash value in year, and this is the net cash value increase, right? And this is obviously the death benefit. So when you see the increase, this is talking about what's going on from year to year. This is talking about, and this net cash value is the cumulative of where it's at now. So if we were to look at this account and we say, okay, well, when did this account break even? This account almost broke even at year 4, right? Because you look, you see, you put in a total of 80,000 and your net cash value is 79,416. So you almost broke even with the cost of insurance by year 4 in this design,
Man.
right? And of course, then by year 5, now you're not even you're past break even and you're making money. This is when the tailwinds, this is when you're kind of taking off, right? And you're just going to continue doing that for the life of the contract, right? Now, this one, I say that this one is kind of like what I feel is the closest to thinking about retirement planning.
Hmm.
And the reason why is because there's been a metric that about 17.9% of people's income is being taken, to fund their retirements, right? So for many, that top rung is about $21,000 a year that they can put in their retirement when it comes to like a 401k account or something like that. So I use 20,000 as a metric that's lower than the top rung of what the 401k would do. Now, the interesting thing though is a Roth tops off at 5,500 to 6,500 that you can put into it. But that's because it's a non-taxable fund. That's because it's a post-tax fund. So this is a post-tax fund that's providing insurance that has no loss attached to it, only guarantee, allows you to use the money, no 59 and a half rule, so it's liquid. You can use it right now. That's what this is, right? So when you look at these numbers, you're looking at a savings account that is incredible. A savings account, not an investment, a savings account. Now, once we get past understanding what a savings account is, you can save money and you can use money from a savings account, right? And so that's the same here. So when you look at, for instance, at year 10 in this account, when they finish there's $235,000, $380 that they could possibly use.
Hmm.
Now, if they were to use that money, this growth the next year hasn't been hindered.
Yeah.
Still same rate because you're borrowing against the cash value, right? You're not borrowing from. Now that's very important to understand. A lot of people don't understand the difference between borrowing against and from because they'll say, "Why are you borrowing from yourself?" That's what I hear a lot of times when they talk about an insurance policy. But here's some clarity. If you were to borrow from like a 401k, it's not an against the 401k, it's a from. Well, why do we say it's a from? Because of the ramifications of the money, right? So once you borrow from a 401k, you freeze the amount you borrowed.
Hmm.
All right. So if I borrowed 20,000 from a 401k, they want that $20,000 back before it goes back into the market to make another dollar. So I froze the growth on it. It won't get a compound. It won't grow. It's frozen. Now, here's the funny part though. What is a 401k? Is it a pre-tax or a post-tax, Joe? Do you know?
Free.
It's a pre.
Mhm.
When you borrow though, what are you borrowing? Are you borrowing pre-tax funds or are you borrowing post-tax?
Thought you would be borrowing your pre-tax. Is it not your pre-tax? Whatever you put in, you.
How are you paying it back though?
Oh, but don't they charge you for taking it out as well?
You're paying it back post-tax.
Yeah, yeah.
So although you're borrowing from a pre-tax, so if I borrowed 20,000, the prime rate right now is 5.5%. I will pay that monthly out of my paycheck
Mhm.
to get back to the 20,000 being paid off for however long they set the tenure, right?
Yeah.
But that interest is post-tax. It's not pre-tax. I'm not getting a tax break on that interest. I'm also paying the loan back as full money that I borrowed. I'm paying back 20,000. I'm not paying back 17,000. I'm paying back 20,000, right? And so when I start to draw it on the back end of my life,
Yeah.
what I'm going to get back from it is going to be based on what my income tax level is. So in essence, I actually paid taxes whenever I borrowed from the account. And I still would have to pay taxes on the back end when I draw it. A lot of people don't think about it, right? It's something that goes right past their mind
Just the
when
act
they think about
is
borrowing.
yeah.
Yeah,
This is
something that goes,
planning.
yes, yes. So that's the difference between borrowing from and against. When you borrow from, it affects the nest egg that you took from, right?
Hmm.
Now, granted, the benefit is because it is a variable account. I don't want to lose any money either while while I owe them money. So I get that. I understand that aspect of it. However, my growth has been stopped on that money, and many people borrow from their 401ks all the time and don't even think about that aspect, right? It never comes into their mind that they could actually be paying more than if they took a hardship withdrawal.
Hmm.
Mathematically, long term, mathematically, it actually ends up costing more. So that's a from scenario. Now, if we were talking about an against scenario, when you borrow against, the growth continues. It didn't interrupt it, right? The only time that the against changes to from is when you decide to exit the contract, right? So usually when you borrow against these contracts, your death benefit drops by how much you borrow,
Okay. Okay.
right? Because your death benefit is the real collateral. So I like to tell people that, for the first time, your life is the collateral. The insurance company has no incentive of killing you for their money. I know that might sound harsh, but you think about it everywhere that you've taken a loan previously, whether it be, on your home, on your car, the incentive is I take the property back if you don't pay me. There's no incentive for them to kill you and then have to pay your family more than what you've taken, right? So it helps people to wrap their head around a much smarter way to borrow money.
It is. It
It's
is.
a much smarter way to borrow money when you think about it like that. Now, of course, on these accounts, and it all depends on how they're structured. So, what you're looking at is what we call a 90-10 design, where 90% of the premium went towards the cash value and 10% went towards the cost of insurance, which is why when you get to year 10, you'll notice, oh my goodness, look at this drop
Mm-hmm.
because the renewable term rider has dropped off of the policy, so it's not kicking in as much money on the death benefit side. However, every one of these policies, you'll notice they grow again,
See that. Yeah.
right?
See
So
that
it
here.
dropped to 570, now you're 625, now you're 680, now you're 737. So it's growing again to cover that basis eventually. It's not that you're never going to have 1.2 million again. In fact, at 53, it'll be 1.2 million again, right? Right where it was when the term was there, right? Um, and the beauty of this is, did you want to start a business? What did you want to do with your life, right?
Wow, I see what you're
What
saying. Yeah.
what did you want to do with your life? You
Just
could have borrowed this money and created your own comp, your own interest, your own dividend, however you want to look at it. You could have created your own ROI, right? I want to buy a truck because I want to be an owner operator. Buy the truck from here, right? You're going to pay significantly less interest on a loan, which means you actually made more money off of buying the truck,
yeah.
right? If you're buying properties, a lot of insurance agents, you have to really, I mean, not insurance agents, but real estate investors, you have to sit them down to grasp this because they're so involved with getting hard money.
Mhm.
Hard money is 12 to 15%, 12 to 15%. And it could be amortized. That's crazy amounts of money to be in the business of investing. Whereas if you were to borrow here, you still have the ability to leverage hard money, possibly if you wanted to, and still build your portfolio because the banks and the credit bureau won't even know that you owe somebody $100,000.
That's
They won't
amazing.
even know it,
Yeah.
right?
Yeah.
That's what makes it an infinite thing with all of the possibilities that could happen for you from a growth perspective. You have a lot more control than you ever had before, and you can make realistic choices. For this person, which I deal with this all the time, people don't want to spend forever working. They just don't. We only work until age 60 because the system tells us 59 and a half is, the first time you can touch these funds without a great deal of tax ramifications. So a lot of people, they want to be done at 52. They want to be done at 53,
And that's young.
right?
60's young. It's still, you have so much more that you can.
Yeah,
Yeah.
yeah. They want to live a life. Like they don't want to just work. They don't want to do something they don't like, right? So let me put it that way. They
Yeah.
might not mind working, but they don't want to do something they don't like,
Yeah.
right? And so when they see the possibilities of something like this, it's like, hold on, you mean to tell me
Yeah. Yeah.
I could have opened up a restaurant?
Yeah.
I could have, I could have did anything with this money to create more opportunity for myself. And the very next year, this was still going to happen. This was still, oh, sign me up, right?
Yeah.
That's the idea, right?
Yes.
And so it's helping people to understand that now you can take control of that banking function, and of course paying the debt back. Like in this situation, paying the debt back makes a lot of sense because it's basically like a line of credit.
Hmm.
Once you pay the debt back, it just opens right back up,
Yeah.
right? So sometimes clients may say, well, what if I need to borrow this? And well, they might set parameters for themselves that might be unrealistic from where they're at, right? They might say, oh, I want to borrow $100,000 in the first year. Well, first and foremost, you don't need necessarily to have $100,000 policy in the first year or 100,000 and 10,000, premium in the first year.
Hmm.
You could have profit margins that would allow you to pay your loans back and still be able to borrow 100,000. So you, if you borrowed 20,000 and then you made your profit off of whatever you did, you paid it back. They reimburse you the interest. They reimburse you wherever was the difference on the interest, and then you borrow the 20,000 again in the same year, and then you do the same thing again, and then you do the same thing again. And that's why it's a loop. That's why it's infinite banking. So it's like recycling money almost, right? Having money to have multiple purposes, which I think is the most beautiful part about it. But it's a lot more clear when you see the designs. So it's
It
a lot
is.
more clear,
It's mind
right?
blowing. It's my now. If
Now,
someone oh, go ahead. You have more.
I was gonna say now I'm also, because of my Medicare nature, I always think about a senior, right?
Yeah.
So how would you feel if you were making 63,000 with no taxes at that time off of a decision that you spent 20 years on and you never took a loss?
Wow.
You never had to risk anything, right? Never had to, well, I don't know, you know. You don't have to go through the ups and downs of feeling terrible after seeing your account drop by $40,000.
Yeah, and it's realistic. Yeah.
It's
Yeah.
realistic because you can touch it now.
And then also, when I did do taxes, if you're earning income like this per month on top of your Social Security, you have to pay taxes on
You
that.
toast.
This
Yep.
is, I mean, not even reportable.
It's not reportable. Yeah. Yeah. That's it's not reportable. Yeah, so you have no requirement to report that there was $63,562 that came in, because one, you took a loan, right? You didn't actually sit there and say, "Oh, I'm gonna withdraw all of this money," because in this situation, it just doesn't make sense to withdraw the money.
Hmm.
I want my money grow. I want all of my money growing all the time,
Hmm. Hmm.
right? So this, the have your cake and eat it too kind of concept. I want all of it, right?
Yeah.
And so if you were even trying to say, okay, well, I'm going to use it as an income base, kind of rewind your mind of how you would use it as an income base. For me, if I were doing this, I would say, okay, well, when I got 63,562, if 5.28% is my loan rate, I pay that and that's my income. Is that better than paying taxes? Much better than paying taxes, right? You'd probably be at least 17%.
And just to confirm, DeAndre, the column you're showing me is dividend payments from the money you put in.
That's just the growth from the
That's
dividend.
growth. Yeah, this is why we had to do this video.
Yeah.
No matter where anyone is, it's something they still should entertain, right? I still think that they should get
Abs-
with you and just see,
absolutely.
see.
Absolutely. So, I mean, when I'm doing this, I mean, I have clients that, let's see, I have one that I've done one very similar to this before.
Mhm.
Let's take a look here. Do you see the amount of premium? $6,000
For the year,
for the year.
that's it, DeAndre?
I've done this before for clients. Look at the cash value at the end of the year.
Okay. Yeah,
$4,906 out of that $6,000.
yeah,
Right?
yeah.
Like, you don't have to be rich, folks. Like, when you watch this, I hope that you're gaining that, hey, I can start where I'm at and then I can build, right? I can start to do some other things further on down the line. Now, of course, and this is just truth be told with any financial strategy, rich people will always have it easy. That's common sense, right? So, no, it's not for the rich, but does it work better for rich people? Obviously, right? We're not going to dodge that. Yes, do I have a football player or two who's putting $1 million in a year? Yeah,
Mhm.
yeah. And when they put in $1 million a year, I mean, by the end of their career, they're making about 1 million passive off of the policy. And they don't work that long, right? They're not in the business that long. So yes, it's possible to do that as well, and it would do way better for them than their regular pension that they have. Yes, absolutely. But is this something that you can touch, that you can do? Absolutely. I don't think $6,000 is that much to say, hey,
No, it's not. not for the benefits of what this is. You
Yeah,
still get your death benefit, you still get your dividend
yeah,
pay. And when you were speaking, I thought about your mentality, right? So if you're starting this with 6,000, if you're already thinking about doing something like this, you will want to get greater policies because you know the benefit.
absolutely,
So your mind's already
absolutely,
with something like this.
absolutely, and it proves it to you,
Mm-hmm.
right? So that's another thing,
Yeah.
right? I hate that, and this is like my soapbox. I hate that you have to prove what an insurance company can do
Mhm.
because all you have to do is read. Like I shouldn't have to prove it to you. You shouldn't, sometimes people say, "Oh, I need to be the guinea pig."
Mhm.
Well, that's not necessarily true. Most of you have watched somebody in your family do something that doesn't work and you continued in that same path. That's why they call them cycles, right? People continue in the same paths all the time of bad things that they've seen that they knew were bad, right? That they knew they didn't understand what was going on, right? you know, and I would say one of those big cycles that I realized that people continue in is not having estate planning, right? 10% of people have estate planning. All of you think it costs more than it does. Prince didn't have estate planning. Michael didn't have estate planning.
Mhm.
Aretha Franklin didn't have estate planning. All of you think it costs more than what it really does. So you allow the thought of that might be too costly to just say, I don't even want to educate myself at all on it. Oh, I'm terrified, right?
We
You
got to
know,
that. Yeah.
and it's important to be data driven and not story driven,
Yeah.
right? We
Yeah.
have to get to a point where it's like, okay, what am I getting out of this? Like I need to make sure I know what I'm getting out of this. I can't just guess everything because every dollar that you have, it needs to work. Now that there's
Yeah.
inflation is outrageous, right? So
It's outrageous. Yeah.
inflation is outrageous. So every dollar you have, it needs to work. And you need to have the comfort of knowing that if something happened to you, your family would not suffer,
Mhm.
right? Um, and I think that we kind of neglect that in society a lot as far as what's going to happen to my family. We kind of hope that we'll assume good things will happen to our family and they won't be that bad in order to sleep at night, right? But we don't do it with things that are forced on us. And so I'll say, for instance, car insurance, homeowners insurance.
Mhm.
Those are things that are forced on us,
Mhm.
right?
Mhm.
But a car and a home is not more valuable than the person who pays for it. It's only there because you continue paying for it. Like it's the only reason why it's there. So then you say, okay, well, life insurance. Oh, I'll cheap it out on that one. Like what? Like it's like I cheap it out on that one. I'm like, I've never understood that. I'm like, okay, so maybe you go to a auto insurance dealer and say, okay, well, hey, can I just get liability? Because well, what happens when you crash your own car? Well, I chose liability because it was cheaper, right? So we have to start thinking about value and not cost because it may be that when you start understanding value, you may realize the cost isn't nearly as much as you thought, right?
Man.
And this is one of those examples because most people will say $6,000. That's not possible. That's within my budget. You can't do infinite banking with 6,000.
Please start. Yes, you can.
You
Wow.
can. You very well can. Yes, I have policies that are like this.
We should be saving anyways, right? If you're
We
not
should be
saving,
saving anyways.
yourself short,
Absolutely.
and you will always never be prepared when an emergency comes up. So
Absolutely. Absolutely.
something like this. And I have one more
Absolutely.
question for you.
Sure.
So now that we went over the examples, if someone were to come to you, they set an appointment, how would you want them to be well prepared to meet with you?
Um, I always want them to understand their why. Like, especially if you're talking about infinite banking in particular. Infinite banking is a lifestyle. It's not a, it's not a policy. The policy is just what you use to facilitate it. It's not, oh, I just want one of them infinite banking life insurance policies, right? And there's so many people whose minds are kind of stuck in that mire, so to speak, that this may not work for them because it is a lifestyle change. It's a realization that, oh, this is actually how money works. Okay, well, let me stick with going with how money actually works and not what I've been told how money works,
Mhm.
right? And so there's a responsibility to be able to be honest with data and not necessarily be like, okay, well, if I do this, people are going to think I'm crazy, right? People are going to think, because that's normally why we make really bad decisions, because we look around at our peers and we're like, but they're not doing it. And it's not the status symbol that we think it should be because other people aren't doing it around us. Um, but the reality is most of the people who aren't doing it around you aren't really in that good of situations. They are one Lego block away, one Jenga block away from everything falling over, typically because they haven't really put their money in the right places, and they don't know what's actually going to happen at the end of this journey. All they know is they're deferring. That's it. That's all they know. And
Yes.
people on the line, deferring is not the same as writing off. I repeat, deferring is not the same as writing off. So when you understand that and you wrap your head around that, you have to know, well, all this stuff I'm deferring, who is it going to hit? You're going to get old one day, right? Now I'm not saying it's not bad to have some things that are deferred, but if your whole portfolio is in deferred and you don't have any other funds that's just not taxable, that's growing, you're going to find out that it's going to be a much harder road than you anticipated. And that's what most seniors find. It's not that it's not that they didn't do good in their life early on, right? So, so it's not that they didn't do good in their life early on. I have clients who are on Medicaid right now and used to be a supervisor at a technology firm. Life happens,
Yeah.
right? Life happens. And this is what makes room for your life to happen, is when you bolster up your life insurance options and customize it better than you've done in the future. That's why it's called life insurance and not death insurance,
Mhm.
right? um, but those other things that you may be doing, it's not really doing that. And so, to book an appointment with me, it requires an open mind to learning how money actually works. If you are not open to learning how money works, don't call.
Yeah. Yeah.
It'll take too long,
Yeah.
right? It'll take too long. Just frankly, it
Yeah.
will take way too long
'Cause you're
to
fighting
try to
with
reprogram you and all that kind of stuff. Um, because what you're doing is really right now you're reprogrammed against what your natural nature is, right? We are not okay with losing. I haven't met a person who is okay with losing.
Mhm.
Not one person. But yet, when you think about the concept of retirement, the first thing you think about is, okay, well, they told me I'm young, so I can go all risk. And if I lose, I can catch back up. You are not comfortable with losing. You've never been comfortable with losing. You've been trained to become comfortable with losing. And now you think that's the only way to do it, that, okay, well, when I lose, it's all right. It's all right. I'll get back there one day. But what if you don't? You know, well, what if you don't? I know for myself, my mom lost a quarter million the year before she retired. She retired in '09. I got married in '09, and my mom was crazy in '08. Right? I didn't know what was going on. But for parents who are listening in, a lot of times, you're not showing your kids like what's going on in your life. And I was very young, so I was still at the home. I basically got married like well, I was in college when I got married. So I was 21, my wife was 19. But but when I was 18 or when I was 20 or so, um I didn't know why my mom was so upset, but she had a chip on her shoulder, right? And it wasn't that she was a bad person. It wasn't that she was a bad mother. She was a lovely mother, but I could tell that there was some type of tenseness in her. But I didn't know where it was coming from. I just started thinking I was a bad kid all of a sudden.
With you had everything to
Hey,
do with
ain't that doing me? But after you lose $250,000, you're gonna be upset. You're gonna be upset, right? And so I want people to really think about that and think, okay, how is the way that I'm investing, or how is my thought process of money, how does it affect my relationships? Right? Because once you realize, oh, if this happened, oh man, yeah, I probably would be down in the dumps. You might need to change some things that you're doing and become dedicated to changing those things,
go.
right, for the better. And so having an open mind and being okay with knowing that it's not that you were wrong, it's that what you were taught was wrong. You might have followed it perfectly, but you could be taught how to do something wrong perfectly, and you could do that perfectly, and guess what, you'll still be wrong, right? you know that's that's how life is, right? But as I mentioned, some the retirement gamble documentary is really a seed that I want people to really plant and watching with their families and saying, oh my goodness, I really need to grasp this. One of my favorite books is the book by Garrett as well, called Killing the Sacred Cows.
Mm-hmm. Mm-hmm.
um, I think once people can really take a step back and look at this stuff for what it is, they'll start to say, you know what, those infinite banking guys might not be that crazy. They might not be that crazy. There is not a bank in the United States that has been around longer than the insurance company. Not one of them. There's not a retirement program that has been around longer than the insurance companies.
Mm-hmm.
In fact, insurance companies precede the actual IRS system that we have. A lot of people don't know that. So it's starting to become a historian of money so that you can grasp why this thing works so well. It involves that much research, but once you do it, you'll be so happy because you're no longer ignorantly, in bliss, but you're in bliss because, man, you're like, I really found it. I understand this now. I know the game now. Okay, let's go. Right, I got a game plan now. It's set. So,
Yeah.
but
Yeah.
yeah, be open minded.
Really enjoyed this. And so, how can people find you and your wife?
Okay, so few different ways. So Clayton Financial Solutions, you can look that up either on Facebook, or you can also look that up. Obviously, our website, claytonfinancialsolutions.com, is the best place to find me. I'll continue doing some appearances and different things like that in different areas. And we also have a radio show from a company called BR, is either WDBR or WDRB. I'm sorry, but I have a, but that's also on my website. And the show is called Liquid Radio every Monday at 9 a.m. So we talk about a number of different subjects, and also highlight businesses as well. So if individuals, have a business that they want some promotion on, I'm open to interview them as well, and give them access to the audience that I've been given to kind of bolster up what they have going on as well. So feel free, everybody, reach out, and I would look forward to, because it makes my content easier. I need some other things.
You are so right about that. Interview.
Man, I tell you, man, I'm like, man, I done talked about money like 6 weeks in a row, and
I need to mix
I'm like, okay,
it up a bit. Mix it up.
yeah, yeah. So I'm like, okay, I talked about money, then I talked about relationships, and really it was I think my favorite episode was about net worth, uh, network making your net worth or something like your net worth being
Yeah,
your net worth,
yeah.
and and I wanted to specify this because sometimes, and even some infinite banking guys do this. I know that real estate guys do this. I know that entrepreneurs do this in general. And I am an entrepreneur. But I want to make this clear that there doesn't need to be a divide between entrepreneurs and workers, right? um, Entrepreneurs, workers aren't beneath you, right? They, yes, you need people who do 9 to 5 jobs to do your business, right? And so sometimes, when we start this journey of entrepreneurship, one thing that we are taught is kind of to separate from people who have a
Mhm,
different mindset than you, right? Like make your net worth your net worth.
mhm.
And so my mindset on that is my net worth, my financial network is a part of my net worth, but I'm never going to look down on, the teachers who I served, because I wouldn't be me if I didn't serve those teachers. I wouldn't be me if I didn't serve postal workers or veterans or anybody else who have had jobs, right? Or doctors or nurses, surgeons, or whoever I've worked with in the past. I wouldn't be me if I didn't serve them, right? And so making sure that we create a balance, because there's such a lack of love in today's world, where it's like,
Mhm.
oh, if you ain't grinding, 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 you're a nobody. And so, your net worth is not your self worth, right? Everybody is valuable. Every last person on the planet is valuable. What they do for the world can be valuable, and they can bring value, right? At whatever role they do.
Mhm.
So, I say that because I come from a long line of postal workers, right? So that's, I'm not gonna sit here and be the guy on the podcast. Oh, if you ain't doing such and such, you ain't nobody, like I'm not. I'm almost somebody. Yeah. So just yeah,
Just another path.
yeah, yeah, yeah. So it's just a different path. We're all different. Different doesn't mean wrong. Yes, are you using the system that America has set up from a capitalistic standpoint? Are you using it efficiently because you're starting to learn that there's a lot of things you can write off? Yeah, sure you are. Right? Sure you are. But that doesn't mean that other people are bad people. They just have different ways of thinking. They have different things going on.
Mhm,
So, you can be a Dave Ramsey. I'm not a fan of Dave Ramsey personally.
mhm.
But you can be a Dave Ramsey person. You can be a Robert Kiyosaki person, right? Um, I can appreciate all of them, not just, the
That's
people in my lane, and what I'm doing, right? So
that goes down to politics, that goes down to religion,
anything,
goes down to everything.
anything,
Yeah, yeah.
anything.
This is
Yeah. So
awesome. I can't wait
yeah.
to talk to you off. Yeah, let me go ahead and stop the recording. But thank you, Deandre, so much. This was so good. I know me and my husband will watch this again and again. I'll watch this on my own. You're just good. You just
Oh,
are
thank
passionate. You have done the research, and the way you convey it is just, it's easy to understand. It's going to help so many people. So I thank you again.
thank you. I appreciate that greatly. Really appreciate that.